So Citigroup just posted its best quarterly revenue in a decade. I mean, we are talking about $24.8 billion in a single quarter.
Right. Just an absolutely massive number.
Yeah, they completely crushed the estimate. And what did the market do the second the earnings call started?
It wiped 5% off their stock price.
Exactly. Just boom, 5% gone. So welcome to this deep dive. Today, our mission is to break down Citigroup's Q2 2026 earnings call. And, we're putting on our talk tickers hats here. We want to translate all that dense Wall Street jargon and the underlying accounting mechanics into actionable, plain English insights for your portfolio, hopefully in under 5 minutes.
Yeah, that's the goal.
So we are looking at the transcript, the analyst Q&A, and of course the rather controversial guidance that management just laid out for the rest of the year. Okay, let's unpack this because that 5% drop is, it's the central paradox we need to solve today.
It really is. Because on the surface, punishing a company for delivering its best top-line performance in 10 years just completely defies logic.
Right. I mean, if I get an A+ on my midterm, my parents don't ground me.
Exactly. But, the stock market isn't a backward-looking grading system, right? It's a forward-looking discounting mechanism.
Which is always the tricky part to remember.
Yep. So to understand the panic, we really have to look past that shiny $24.8 billion revenue figure and dig into the mechanics of bank profitability. Specifically, we need to look at how Citigroup is allocating its capital for the future.
Which makes sense. I mean, a 14% year-over-year revenue jump for a legacy, heavily regulated, global, systemically important bank is staggering.
Oh, it's huge.
Right, like they aren't some nimble tech startup moving the needle 14% on a $250 billion balance sheet that requires a massive amount of momentum.
A lot of momentum. And the bottom line followed suit, too. I mean, earnings per share came in at $3.15, and total net income hit $5.8 billion.
But there was this one metric that management just kept hammering on the call, the one that, truly measures a bank's pulse.
Right, ROTCE.
Yeah, ROTCE. They posted a 13% ROTCE for the quarter. Let's explain that for a second.
Sure. So that stands for Return on Tangible Common Equity. And honestly, if you are analyzing financial stocks for your portfolio, this is basically the ultimate scorecard.
The holy grail for bank metrics.
Exactly. It strips away all the accounting fiction and shows you the actual operational leverage of the business.
So let's define the boundaries of that metric real quick, because it is distinctly different from just your standard return on equity. I mean, the tangible modifier in there does a lot of heavy lifting.
It really does. So standard equity includes basically everything on the asset side minus the liabilities, right?
Right.
But a bank that has been around as long as Citi and, has acquired as many entities as Citi has over the decades, they carry billions in intangible assets on their balance sheet.
Things like goodwill, right?
Exactly. Goodwill, which is the premium they paid over book value for past acquisitions or, the theoretical value of brand names, those are real accounting entries. But here's the thing. In a liquidity crisis, you cannot sell goodwill to pay depositors.
Right. Nobody wants to buy your brand name when there's a run on the bank.
Exactly. So tangible common equity just forcefully removes all of that. It isolates the cold, hard, physically liquid capital that actually belongs to the common shareholders.
Okay, so it basically measures the raw efficiency of the cash engine. Like, for every dollar of real unprotected cash the shareholders have left inside the bank, how many cents of actual profit did the bank generate this year?
Precisely. And in the banking sector, hitting a double-digit ROTCE is like the dividing line between a bank that is destroying shareholder value and a bank that is creating it.
Okay, got it.
So at 13% for the first half of the year, Citi's engine isn't just healthy. I mean, it is running incredibly hot. They are generating premium returns on their core capital.
Which brings us right back to our central paradox, right? Because a 13% return is bulletproof. The top line is historically strong. So why on earth the sell-off?
Yeah, to figure out why the Wall Street algorithms hit the panic button regarding the future, we have to look under the hood at exactly which divisions are propping up that 13% today.
Because Citi isn't just one big bank, it is essentially a massive multinational conglomerate of distinct financial businesses.
Right. And according to the transcript, 4 of their 5 main units saw double-digit revenue growth.
4 out of 5. I mean, the underlying momentum is undeniably strong there. Let's start with their services segment, which is arguably Citi's crown jewel.
Oh, without a doubt. It encompasses Treasury and Trade Solutions, or TTS. And this is, it's the unglamorous, highly complex plumbing of the global financial system.
The stuff nobody thinks about but makes the world go round.
Exactly. They handle cash management, payroll processing, and cross-border trade finance for multinational corporations.
Which is no small feat. I mean, moving billions of dollars across 50 different regulatory environments, handling the foreign exchange, all the localized compliance, the vendor payments, it is an immense logistical hurdle.
Oh, absolutely.
And that hurdle forms a massive economic moat, doesn't it? A Fortune 500 company cannot simply switch its global treasury operations to a regional bank down the street.
No, they can't. The switching costs are just way too high. And, that moat is really reflected in the numbers. Services delivered its highest ever quarterly revenue with a return of over 30%.
Wow, 30%.
Yeah, but the true milestone, the one kind of buried in the CFO's commentary, was that deposits in this specific segment crossed the $1 trillion mark for the first time.
$1 trillion? That's an insane amount of money.
It is. And the CFO, Gonzalo Luchetti, he was very careful to specify that these are operating deposits.
Okay, that distinction is super crucial right now, especially in a macroeconomic environment where interest rates have been, elevated for a while because capital is incredibly flighty right now.
So flighty.
Right. Retail customers and massive hedge funds alike are constantly yield-seeking, moving cash to whichever money market fund or regional bank is offering an extra 20 basis points of yield.
Yep, they just chase the highest rate.
Exactly. Which forces banks to pay up to keep those deposits, and that just crushes their net interest margins. But operating deposits operate on a completely different logic, right?
They do. Operating deposits are sticky. A massive corporation like Toyota or Apple, they aren't going to move the cash they need to make payroll next Tuesday just to chase a fraction of a percent in yield.
Right, because they need that liquidity immediately.
Exactly. That money has to sit in checking and operational accounts just to keep the lights on.
Yeah.
So by securing $1 trillion of this specific type of corporate cash, Citi effectively secures a massive, stable pool of cheap funding. They don't have to compress their margins to retain it.
Which gives them incredibly cheap leverage to lend out or invest elsewhere. I mean, it is the perfect foundation for a bank.
It really is.
And then next to that, you have the banking segment, where the numbers just went parabolic. I mean, investment banking revenues were up 44%.
Yeah, huge up.
And within that umbrella, equity capital markets ECM shot up an unbelievable 92%.
Yeah, the ECM boom is directly tied to the current macro narrative. I mean, equity capital markets is the division structuring and executing initial public offerings, secondary offerings, and convertible debt.
The big ticket deals.
Right. And Citi didn't just participate in the broader market recovery, they actually took significant market share. Jane Fraser noted they were a lead book runner on 8 of the top 10 ECM deals of the quarter.
Wow. 8 out of 10.
Yeah, and she explicitly named the SpaceX and Cerebras transactions.
Okay, that is huge because being the lead left book runner on a SpaceX or Cerebras deal isn't just about the immediate underwriting fees, which I'm sure are substantial.
Oh, they definitely are.
But it is also about cementing your position in the AI and aerospace super cycles. Like when you take Cerebras public, which is, a major challenger in the AI chip space, you are positioning yourself to handle all their future debt issuances, their future M&A advisory, and even the personal wealth management of their newly minted billionaire founders.
Exactly. It creates a multi-decade revenue pipeline.
Yeah.
And the institutional activity didn't stop at capital formation either. Over in the market segment, which is their institutional sales and trading division, equities trading jumped over 40%, pushing total markets revenue past $7 billion.
So the prime brokerage desks and cash equities traders were just firing on all cylinders.
Oh yeah, totally on fire.
And you really see the downstream effect of all this corporate and institutional dominance trickling into their wealth management segment too. Revenues there jumped 13%, pulling in $30 billion in net new assets just this year alone.
That's a huge influx of capital.
It is. But the detail that really caught my eye in the transcript was the 23% increase in referrals from their standard retail banking tier up to their high-end Citigold wealth management tier.
Oh man, That referral metric represents a massive structural breakthrough for Citigroup because historically, large global banks have been notorious for failing at cross-selling.
They operate in extreme silos, right?
Exactly, extreme silos. The retail bank manager had no financial incentive and honestly often no technological capability to seamlessly hand off a high net worth client to the wealth management division.
Because the systems didn't talk to each other.
The systems didn't talk and the compensation pools were totally isolated.
It's the classic synergy trap. Like management promises the street they will cross-sell the retail base, but the corporate bureaucracy prevents it from ever actually happening in practice.
That's it, exactly. But Jane Fraser has spent her tenure tearing down those internal walls. She's been restructuring the compensation models to actually reward cross-divisional referrals and, integrating the technology stack so they can communicate.
Wow, okay.
So seeing a 23% jump in internal transitions, that means the actual plumbing of the business model is finally working. You acquire a client early in their career, and as your net worth scales, you capture the higher margin wealth management fees without having to pay external customer acquisition costs.
That makes total sense. So we have services, banking, markets, and wealth all exhibiting exceptional, highly profitable growth. Which, of course, brings us to the fifth segment and the primary source of the friction on this earnings call, U.S. consumer cards. The credit card division.
Right, the squeaky wheel.
Revenues here were up a meager 1%, but expenses skyrocketed by 10%.
Yeah, that specific divergence, a 10-to-1 ratio of expense growth to revenue growth is exactly what initially triggered the algorithmic selling.
Look, I am going to push back hard on management's narrative here because they are framing this 10% expense spike as investing for growth.
Right.
But they spent a fortune on marketing to acquire new accounts, and they outright purchased the American Airlines Barclays credit card portfolio, onboarding over $6 billion in loans from 2 million new accounts in April alone.
That's a lot of new accounts very quickly.
Right. So you are telling me that buying a massive book of unsecured consumer debt at what could be the absolute peak of an economic cycle, when savings rates are dwindling and consumer stress is rising, is a smart play. That sounds like catching a falling knife and calling it a fence to me.
I get that perspective. I really do. But that assumes the consumer is fundamentally cracking, which, the data inside the portfolio doesn't necessarily support.
Really?
Yeah, yes, they acquired $6 billion in loans, which incurs massive upfront partner fees, marketing costs, and immediate loan loss provisioning. Because when you buy a credit card portfolio, accounting rules basically dictate you must immediately set aside capital for expected future losses.
Right, which front loads the expense before you ever collect a single dime of interest revenue.
Exactly. But if you look at the actual credit performance, their net credit losses are hovering around 4% to 4.5%.
But wait. A 4.5% default rate on unsecured credit isn't exactly pristine, is it?
It isn't pristine, no, but it is normalized. For a portfolio that's heavily weighted towards travel rewards and co-branded airline cards, which, by the way, tend to attract slightly higher credit tier consumers than your standard subprime cashback cards, a 4.5% loss rate is historically pretty standard.
Okay, fair point.
It basically indicates the U.S. consumer is bending, perhaps reverting to pre-2020 behavior, but they are not breaking. The friction you are seeing is just a fundamental mismatch between the timing of customer acquisition costs, or CAC, and the lifetime value of that customer.
Okay, I see. It's like the fixer-upper mechanism. You buy the distressed property, you pay the contractor today to gut the kitchen and fix the roof, and that drains your cash flow immediately.
Yep, perfect analogy.
You don't see the return on equity until you appraise the house 3 years later. So Citi is basically eating the acquisition costs of 2 million new accounts today, betting that the interest revenue and swipe fees will compound over the next decade.
Which, is a strategically sound bet for a bank with $1 trillion in cheap operating deposits to fund those exact loans.
That's true. They have the cheap funding.
But the problem is Wall Street operates on a 90-day expectation cycle. They have very little patience for deferred gratification. So they see a 10% expense growth print on a spreadsheet. They see the immediate drag on current quarter margins, and they just hit sell.
Okay, but even so, the U.S. consumer card expenses alone don't explain a 5% drop in the entire stock price on a day they beat revenue estimates by billions.
No, they don't.
To understand the true source of the panic, we really have to look at the forward guidance because we established that the first half of the year was phenomenal, right? Averaging a 13% ROTCE. But then, during the Q&A, management reiterated that their full-year target for ROTCE remains 10% to 11%.
Yeah, and the arithmetic implied by that reiteration is what sent shockwaves through the analyst community.
Let's do the math on that for a second because it is glaring. If your first 6 months average a 13% return, and you were telling the market your 12-month average is going to be 10.5%, that requires a catastrophic drop-off in the second half of the year.
It really does.
You would have to post single-digit returns, maybe 8% or 9% in Q3 and Q4, just to drag that blended average down so drastically.
It implies an absolute cliff. The analysts on the call instantly caught it. Glenn Schorr from Evercore ISI and Mike Mayo from Wells Fargo, they practically cornered management on this specific point.
Oh, they're out for blood.
They really were. They bypassed the standard congratulatory pleasantries entirely and basically demanded to know what macroeconomic disaster Citi was quietly bracing for.
Right.
Schorr essentially asked if they were modeling for a severe recession that would naturally drag returns into the single digits.
And Mike Mayo was even more aggressive, right? He accused them of sandbagging the guidance, demanding to know if they were playing defense because they saw credit markets freezing up or consumer spending just falling off a cliff in the fourth quarter.
Exactly. And this is where Jane Fraser's response became the defining moment of the entire transcript. She didn't let her CFO deflect the question with accounting jargon. She stated unequivocally that the firm is 100% on the offense and that this is a bank on the front foot.
I mean, that sounds great, but those are just corporate buzzwords. How do you actually reconcile being on the offense with engineering a deliberate dive in your core profitability metric?
Well, you reconcile it by looking at the mechanics of structural reinvestment. What's fascinating here is that Citi generated a massive unexpected windfall in the first half of the year due to that 92% spike in ECM and the 40% jump in equities trading.
Right. They had all this extra cash.
Exactly. Now, a structurally weak bank, one that is truly worried about its survival, would take that windfall, drop it straight to the bottom line, and use it to artificially inflate their full-year earnings to appease shareholders and secure their own executive bonuses.
They would just hoard the cash to absorb the incoming shock.
Yep. But a management team that actually believes their own turnaround story looks at that excess capital and decides to spend it immediately to permanently fix the bank's underlying flaws.
Oh, I see.
They are taking the windfall from the first half and actively choosing to expense it in the second half. So the drop in H2 returns isn't happening to them organically. They are orchestrating it.
Okay, so where exactly are they burning this windfall? Like, what are they buying?
The capital deployment is heavily concentrated in three main areas. First, accelerating technological investments. They are pulling forward massive capital expenditures into AI integration across all their compliance, risk modeling, and back office functions.
Right.
Because for a globally systemic bank, AI isn't some parlor trick for generating emails. It is a mechanism for automating thousands of hours of regulatory reporting and real-time fraud detection.
Right, which fundamentally lowers the cost to serve each marginal client going forward. Okay, that makes sense. What's next?
The second bucket is the marketing spend for the credit card acquisition we already debated.
Got it.
But the third bucket is honestly the most fascinating from an accounting perspective, and that's severance.
Severance and stranded costs, yeah. Management disclosed they have already spent $800 million year to date strictly on severance packages.
Yeah, $800 million.
Which, spending nearly $1 billion just to pay people to leave sounds disastrous to a retail investor. But in the context of corporate turnarounds, paying severance is essentially buying back your own operating leverage, isn't it?
It is. It's the most direct way to permanently alter your cost structure. Look, Citigroup is in the middle of a massive global contraction right now. For decades, they operated full-service consumer retail banks in dozens of countries, from Poland to Mexico to Southeast Asia.
It was huge.
It was an unmanageable regulatory nightmare that required thousands of redundant compliance officers, localized HR departments, and middle managers all over the globe. Jane Fraser has systematically sold off those international franchises.
But when you sell, say, the Polish consumer bank, you don't instantly shed all the costs associated with overseeing it from New York.
Exactly. You are left with what the industry calls stranded costs. The revenue from that country vanishes immediately upon sale, sure, but the New York-based IT systems that supported it, the regional vice presidents, the redundant software licenses, all those costs remain stranded on your balance sheet.
So they just sit there eating into your margins.
Yep. So the $800 million in severance is the blunt force cost of untangling that bureaucracy and permanently eliminating those layers of management.
Okay, so let me get this straight. They are taking the trading windfall and using it to fund the severance packages today, so that in 2027, the structural baseline cost of running the bank is billions of dollars lower.
Exactly.
Plus, on top of all that spending, the CFO highlighted the natural seasonality of the markets business.
Yes. Trading revenues historically declined by roughly 20% in the second half of the year anyway.
Because of the summer slowdown.
Right. The summer doldrums hit, institutional desks take vacations, and volume just naturally thins out heading into the winter holidays.
Okay, let's synthesize all of this. You take a natural 20% cyclical decline in trading revenue, you add a deliberate, massive spending spree on AI infrastructure, you fund $1 billion in severance to shrink the bureaucracy, and you absorb the upfront acquisition costs of 2 million credit card accounts. Suddenly, an engineered drop from a 13% ROTCE down to an 8% or 9% ROTCE doesn't signal an economic collapse at all. It just signals a management team that finally has the cash flow to renovate the house without asking shareholders for more money.
Which is the perfect pivot to the bottom line, right? Because what does this specific earnings call mean for a retail investor who is holding the stock, or maybe looking to initiate a position?
I will take the definitive stance here. I think the 5% drop on the day of the call was a gross mispricing by short-term traders and algorithmic systems that just cannot distinguish between defensive deterioration and offensive investment.
I agree completely.
Throwing a tantrum because the H2 spreadsheet looks slightly worse, while completely ignoring the structural improvements driving the H1 beat, is just incredibly short-sighted.
It is. The fundamental narrative here is exceptionally bullish. Citi is executing a complex turnaround while still delivering double-digit returns on tangible equity. That is a position of immense financial strength.
Absolutely.
So if you're an investor, the noise around H2 expense timing is really secondary. The primary metrics you should be evaluating are capital returns and structural simplification.
Let's drill into those capital returns, because this is where the theoretical accounting translates into actual wealth generation for you, the listener. Management announced a 12% increase to their dividend. That is a massive hike for an established financial institution.
It is, but a 12% raise on the dividend is a direct wealth transfer to shareholders, sure, but it honestly pales in comparison to the structural impact of their share repurchase program.
Oh, the buybacks.
Yeah, Citi has a $30 billion share buyback authorization underway, and they executed $4 billion of that in this quarter alone.
The mechanics of a share buyback are often misunderstood by retail investors, but they are absolutely vital to the bullish thesis here.
They are.
When Citi takes $4 billion in cash and buys its own stock on the open market, they retire those shares. They cease to exist. So if you own 100 shares of Citi today and the company destroys 10% of the total outstanding share count, your 100 shares suddenly represent a larger ownership percentage of the entire company, and therefore a larger claim on all future earnings.
It's beautiful. It mathematically forces earnings per share to rise, even if the underlying net income stays completely flat, simply because the profits are being divided by a smaller denominator.
Right.
But there is a secondary signal here, too. A management team authorizing a $30 billion buyback is explicitly telling the market, we have analyzed our internal cash flows, we have looked at the current stock price, and we believe our own equity is the single most undervalued asset we could possibly buy.
Which is a huge vote of confidence.
It is. It establishes a formidable floor under the stock price, as the company basically acts as a persistent, deep-pocketed buyer of any dips.
And that buyback engine is about to get a massive injection of fuel from the simplification strategy, specifically regarding Banamex.
Right. Banamex is the linchpin of the entire divestiture strategy. It is their massive consumer banking operation in Mexico. And they confirmed on the call that they are still on track to execute an initial public offering for Banamex in early 2027.
But wait, why should an investor care today about an IPO schedule for 2027?
Because of the mechanics of regulatory trapped capital.
Okay, explain that.
So when a bank like Citi operates a subsidiary in a foreign jurisdiction like Mexico, the local regulators there require them to hold billions of dollars of common equity tier 1 capital-like hard cash in reserve, specifically within that country, to backstop the local loans.
just to make sure the local bank doesn't fail.
Right. Citi cannot legally move that money to New York to pay dividends or buy back stock. It is just trapped there.
Ah, okay. So the moment they successfully spin off Banamex into an independent, publicly traded entity, the regulatory burden transfers to the new company.
Exactly. And management estimates the Banamex IPO will untrap roughly $5 billion in capital.
Wow.
That is $5 billion of cold, hard cash suddenly freed up on the balance sheet of a company that is already heavily committed to share repurchases.
So it is a massive, quantifiable catalyst sitting just over the horizon. When you aggregate all these data points, the verdict becomes incredibly clear. Management is playing a methodical, multi-year-long game.
They definitely are.
They are actively choosing to endure the pain of severance costs, the friction of marketing expenses, and the drag of tech upgrades today, with the explicit goal of permanently elevating their baseline returns to 14% or 15% over the medium term.
So for a retail investor with a time horizon measured in years, not days, this earnings call was a resounding green flag.
Total green flag.
You are basically watching a historic turnaround, actively working in real time. The bank is generating so much organic cash flow from its services and banking divisions that it can afford to self-fund its own restructuring while simultaneously paying you a higher dividend and retiring a massive percentage of its outstanding shares.
The market effectively mispriced the cost of the renovation, offering long-term investors a 5% discount on a structurally sound, accelerating business.
Exactly.
The fundamentals are undeniably strong. However, and this is a big however, no investment thesis is completely devoid of risk. And there is one specific macroeconomic dependency buried in these results that we definitely need to address before we wrap up today.
Yes, and it circles back to the massive outperformance in the investment banking division. Jane Fraser explicitly cited the extraordinary investment in AI and its supporting cast as the primary tailwind driving their corporate client activity in their equity capital markets deal flow.
Right. Cerebras, SpaceX, the massive data center buildouts, the power grid upgrades required just to run the GPUs. The AI supercycle is effectively subsidizing Wall Street's fee pools right now.
And here is the structural risk with that. What happens if the timeline for artificial intelligence ROI gets extended?
Right.
If the massive capital expenditures by the tech giants face a bottleneck in late 2026 or 2027, whether that's due to supply chain constraints, power grid limitations, or honestly simply a realization that the software monetization will take longer than expected, the frenzy for AI-adjacent IPOs and debt issuance will just freeze.
And if the AI narrative cools off, the private companies stop going public. The ECM fees just vanish overnight.
Exactly. And if those fees vanish, the 13% ROTCE that gave them the excess capital to fund their restructuring in the first place suddenly comes under severe pressure. It is arguably the single largest macroeconomic vulnerability hiding within these phenomenal headline numbers.
It is the ultimate caveat for you, the listener, to mull over. Citi passed this quarter's test with flying colors, but their future grade is heavily dependent on the sustainability of the broader tech sector's capital spending. So keep a close eye on the macro environment, monitor the pace of the Banamex divestiture, and track the underlying growth in those sticky operating deposits. Thank you for joining us for this deep dive into the mechanics of Citigroup's turnaround, and we will see you on the next one.